Good day, ladies and gentlemen, and welcome to the show on this June the 27th, 2021. Thank you for tuning in. Now, listen, guys, I'm expecting some volatility right to the end of this year in silver and gold. And what I mean by volatility is most times volatility means to the downside. And I'm going to explain to you guys why. We got all of these people, these banks out there. You get a tremendous amount of short positions in gold. You guys know the gold and silver market for a long time now has not been controlled by the actual metal. It's been controlled by the paper price of paper short contracts, which are not the actual metal. It's just basically the metal written on a piece of paper. It says this is the metal. It's not the metal. And this paper outnumbers the real gold and silver by thousands of times over. This is why they can trade a billion ounces in a day. Is not uncommon, in these markets, trading paper back and forth. They're not trading real physical metal. That's almost 2 years mining production. No, they're trading the paper back and forth. Just become a paper market. That's all it is. But now under Basel III regulations, by the end of this year, which is going to be implemented, they've got a problem because those unallocated positions, which are these paper short contracts, are only going to be counted as 85% within the banking system. So I can guarantee you they're going to want to get out of these. They're going to want to not have them. They're going to want to have what's called allocated positions. And what an allocated position is, it's the real metal in your hand. Because they can get counted under the new regulation as a Tier 1 asset. The allocated metal. That means that the banks are not going to want to buy the paper anymore. They're going to want to hold the real thing. They're going to want physical. Right? But they're going to want to get rid of this paper. And so what we're going to have is, I think that we did see them move off a little bit of paper, just a week or so ago when the gold and silver price dropped. But they have to realize that if they dump all of their paper, because it's hundreds and hundreds of one to the real underlying asset, if they dumped it all at once, the gold and silver price would do what happened with oil. Remember when oil went to a negative $30, negative $40? And of course, what would happen is it would all get snatched up. You wouldn't be able to buy any. If the paper price of gold and silver, the spot price, went down to zero, how many people would be lined up at the silver and gold store? Do you really believe there'd be any to buy? So they can't dump all of their paper short contracts all at once. But I think they're holding them right now. They're still holding them, and they're holding massive, massive volumes of them. Probably in silver, it's probably like 400 paper short contracts saying you own a piece of silver to every 1 actual ounce of real silver. Imagine if they dumped them, what it would do to the price. But I think they're trying. They want to dump them. And so I think we're going to be going through this game. It's going to last until the end of the year, where every time if the price of gold and silver try to go up too much, they're going to try to dump a bunch of these paper short contracts and get out. So I got 4 articles to go over with you guys. And, we're going to get looking at the first one right here. The first one is about the Fed. It says, and while it is easy to condemn the Fed for having enabled the decades of dysfunction, it is the political system that must bear the blame. But no matter, the Fed must soldier on like a magnificent machine, attempting the impossible, delivering certainty, but without fragility, spinning ever faster and faster to stand still. And the greatest risk it now faces in meeting its mandate is the economic crisis accompanied by inflation. Such a crisis would force the Fed to choose between a return to orthodox policy and the consequential defaults that would devastate asset prices, or a currency collapse and runaway inflation that rebalances the value of our assets and liabilities. Without a determined improvement in our policies, without a determined improvement in our politics, it is increasingly likely that we will endure the latter, followed by the former. And this dilemma will surely play out in the decade ahead. So I'm going to give you that in my own words. The Fed's trapped. They're trapped between a crisis that where the whole thing deflates and the consequential defaults, it says here, would devastate asset prices. No, let's go a little bit further than that. The whole system has been so over-leveraged that that's impossible to have that without it freezing the entire system, right down to small businesses and everything. See, the system works now on trickle down. Every place, your restaurant chain you go to, they got a bank behind them. That bank's got a larger bank behind it. When the system starts to break down and actually everything starts to lock up and credit isn't extended anymore, and bankruptcies are too big because the system is deflated, the system actually freezes. So the upper part of the system freezes, the lower part freezes. It's kind of like a snake slithering along the ground, you know? If something comes along and clunks him in the head, say a car runs over his head, the whole snake's finished. Doesn't matter that the rest of his 6-foot-long body is in perfect shape. His head's been squished. And that's the way with the financial system. As long as the upper echelons of the financial system, credit is flowing freely, and this is why I go through and I show you guys a MOVE index every day, because that's your window into the credit markets. As long as that's moving and everything's moving within the system and the Fed's able to move money back and forth and everything, then it trickles down the whole rest of the system, even if it's in terrible shape. You get bankruptcy, stores closing, people are out of work. Still, the upper end's working fine. So it's like the head. The head's working fine, so the rest of the body continues to function. Maybe it's not functioning well, but it functions. But if the head gets squished, and that's what deflation would do, it would stop it from the top down instead of from the bottom up. That's why they can't allow it to happen. That's why they're so scared of it, because it would lead to a implosion of the system. So that first part, that can't happen. It just can't happen because the system would lock up. What about hyperinflation? The second part he was talking about here. Well, that can happen, and that's probably what's going to happen, and that's what he says here. He says, our politics is increasingly likely that we will endure the latter, followed by the former. It's kind of the way he put it there. It's a little bit difficult to understand, but basically what he's saying is runaway inflation that rebalances the value of our assets and liabilities. And that is the way it's going to go. But we're going to go through these deflationary pulses of deflation that they have to react to. The Fed reacts to each time. And we've already been through this, so you guys know what it looks like. Remember back at the start of this pandemic crisis? The system was starting to deflate. The stock market was crashing. What happened? 2.2 trillion stimulus package. This game's going to happen again. And I'm predicting it's going to happen again early in the new year. Because that's when the money's going to run out, guys. All that stimulus, they're not doing it. They're cutting back now. And in fact, they're trying to drive liquidity out of the system through this reverse repo market action that's going on right now. And so, toward the end of this year, I think we got enough momentum to carry us through into next year, sometime in the next year, but not much further than that. And we're going to have another deflationary, I think it's going to look very similar to what happened at the beginning of this crisis, that the pandemic crisis, when the markets were crashing. It's going to look very similar to that. Meanwhile, we got this rocky ride coming with gold and silver, with them wanting to get out of their paper short contracts. So this is going to be one heck. This next year is going to be so interesting, guys. It's going to be so interesting. Let's move on to the next slide. Binance, one of the world's largest cryptocurrencies exchanges, was banned on Sunday from any regulated activities in the United Kingdom, while Britain's financial watchdog, the Financial Conduct Authority, imposed stringent requirements against Binance, a sprawling digital asset firm with subsidiaries around the world. The exchange has until Wednesday evening to confirm it has complied with the watchdog's demands, including removing all advertising and financial promotions. Binance must also make clear on its website and its social media channels and all other communications that it no longer is permitted to operate in the United Kingdom. As part of the FCA's actions, regulators ordered Binance to display the next Wednesday on its website that Binance Markets is limited and not permitted to undertake any regulated activities in the United Kingdom. I'll tell you, this kind of setting precedent right here. Could be setting precedent. Cryptocurrencies, you have to understand something. Cryptocurrencies wants to replace the power that's belonged to these authorities for thousands of years, the power to create and control money, or what they call money. It's actually just, well, up until 1971, it was backed by gold. But money, the stuff you used to pay taxes with, they control it, and they've controlled it forever, right? And this cryptocurrency markets, they rely upon these exchanges, and Binance is a big exchange, one of the world's largest cryptocurrency exchanges, and now they're not allowed, they're not welcome in the United Kingdom. So get you guys, if you're into crypto, start thinking, about things like this. Okay, let's move on to the next slide. They're everywhere. Mega drought sparks grasshopper plague in the western United States. Grasshoppers, another name for them, locusts. And they can come in swarms and they can devastate crops. I'm going to tell you guys, it's bad enough that their crops are drying in the field. I hear they can plant a ton of wheat, and they're only harvesting like not much more than they're planting. And they're supposed to harvest like at least a dozen times what they plant down, many times over, because there's no water. You can't have a farm with no water. You don't have a farm, next thing you know, the supermarket doesn't have any grain. So we got to watch out for this kind of situation. They're calling it a grasshopper plague, but this is all part of a giant dust bowl that's forming out in the Midwest and out in the Western Canada as well, where they grow crops like canola. Every time you go for some fries at your favorite local fry joint where they make French fries, what do you think they cook the fries in? Canola oil. I'm sorry, and we're having an oil shortage this year. Oil prices have went from $4 a gallon to $400 a gallon. What are you going to cook your fries in then? I mean, this is ridiculous, but it's happening in real time right in front of us. The whole western half of the United States is drying out. And Canada. Fires. We got to watch out for fire season this year. Okay, next slide. It's talking about unemployment. You can be unemployed in the traditional meaning of the term without being counted as unemployed by the Labor Department. The difference has to do with whether you are actually looking for a job or not. Only the former are actually counted as unemployed. The problem is that the ranks of the latter are growing. There are some in the prime age working population, age 25 through 54, who are not looking for jobs because they are homemakers, students, early retirees, are undergoing various life transformations. Still, The percentage of the potential workers who have dropped out of the labor force is disturbingly high. Some are giving up on jobs because they are sure they can't find any that match their skills or interests. Others are content to collect the generous unemployment benefits the government keeps handing out. Some are still living in fear of COVID and not want to return to the workplace. Can't say I really blame them. But you know what? This is growing, this thing where they're not counted. And the real unemployed in the American labor force must be tremendously higher than the actual numbers that they're showing. Okay, let's move on to the next slide. Gold has an advantage that Bitcoin does not have, that Bitcoin inherently cannot have, which is its age. Gold has survived and performed its job for literally thousands of years. We shall have to wait a little longer to see if Bitcoin is as good as gold. Well, you know, I've noticed something that's happening. I don't know if it's going to continue. But Bitcoin and gold are sort of interchangeable. And Bitcoin can be moved so much easier than gold. Gold's heavy, and people want to steal it. You try to move gold, they're going to stop you at the border, and they're going to confiscate it, everything else. But Bitcoin can fluidly move around the world so quickly and easily. But it's like gold in that you can transfer back and forth between gold and Bitcoin. So basically what I'm saying is if you were a businessman living in Argentina and you had a gold bar, you could sell that gold bar, transform it into Bitcoin, move the Bitcoin over to whatever new country you're heading to, and then transform that Bitcoin back into gold again by buying gold. It would be much easier than trying to move the actual physical gold. Nearly 2.5 millennia ago, Aristotle wrote that the famous treatise on money. Money serves as a medium of exchange, a store of value, and a unit of account. In his treatise, Aristotle listed the characteristics of ideal money. And guess what it boils down to? Gold. It's ideal money. It's maintained its purchasing power for thousands of years. Let me see here. It says other countries abandoned the pure gold standard, and there was a period of a dirty standard followed by the Roosevelt confiscation of gold, and ultimately the closing of the gold window in 1971. Gold's last formal link to the money system, gold's purchasing value was within 1% of what it had been in 1560. That's a long time. During that long period, the maximum loss. So 1%. Well, I know back in the 1920s, you know, they use a suit as an example of how gold maintains its purchasing power. So, you know, it's probably just about right on cue for how much inflation we have. Remember, just a couple years ago, gold was $1,150, and now it's what, about $1,800. That's the amount of inflation you've seen. Same thing with silver. Silver was like $13.80 around the same time, and now silver is like 26, 27 bucks. That's the difference in what you can purchase with those dollars. It's reflecting that, and it's going to continue to reflect that. We go into a hyperinflation, gold and silver is still going to retain your purchasing power. A lot to think about today. We got a lot going on. Thank you guys for listening. Like and subscribe, and we'll catch you guys in the next show. Bye-bye.